Today was one of those sessions that looks calm on the surface, but actually tells us a lot about what the market is preparing for. The S&P 500, Nasdaq, and Treasury yields all moved, but not in the same direction and not with the same conviction. And that divergence matters. In this video, we'll break down what really happened in SPY and QQQ, why 10-year yields stayed elevated, and what today's price action tells us about risk appetite going into the next sessions. Let's start with the S&P 500. SPY opened near previous highs and initially tried to push higher but failed to hold momentum. We saw an early spike, followed by selling pressure into the middle of the session, and then a modest stabilization. What's important here is not the size of the move, it's the location. SPY is still trading very close to recent highs, but every push higher is being met with sellers. That's classic late-stage price behavior. Buyers are still present, but conviction is weaker. This kind of price action usually signals distribution, not panic. Large players are reducing exposure slowly, not exiting aggressively. That tells us the market is hesitating, not breaking. Now, let's look at QQQ. Tech initially showed relative strength, but just like SPY, momentum faded quickly. After an early push, QQQ rolled over and spent most of the session moving sideways with a slight downward bias. This matters because Nasdaq usually leads risk sentiment. When QQQ fails to extend higher while indices are near highs, it often signals exhaustion in growth stocks. There was no panic selling, volume stayed controlled, but buyers were clearly unwilling to chase prices higher. That's a key psychological shift. The market is no longer pricing upside acceleration, it's pricing uncertainty.
Now let's talk about the most important chart today, the 10-year Treasury yield, TNX. Yields stayed elevated around the 4.16 to 4.18 area and refused to break lower. This is critical. As long as yields remain high, equity multiples face pressure, especially in tech. Today's equity weakness didn't come from bad news. It came from the cost of capital staying expensive. In simple terms, yields are telling us financial conditions are still tight, and stocks are being forced to respect that reality. This is why rallies are getting sold faster than before.
So what did the market actually tell us today? Not fear, not euphoria, but hesitation. This is the kind of session that often appears before larger moves, not after them. When stocks stop reacting strongly to good news and yields stop falling despite equity weakness, the market is usually waiting for a catalyst. That catalyst could be economic data, inflation expectations, or a shift in rate expectations. Until then, expect choppy price action, failed breakouts, and fast reversals. As long as yields stay elevated, upside in equities remains limited. If yields finally break lower, risk assets get breathing room. If yields push higher, volatility returns quickly. For now, the market is not breaking, but it's definitely losing momentum, and that's something traders should respect.